Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
Palantir Technologies, I'll show you how to value elite growth. This article was written by Dhiren Bekai. Summary. Palantir Technologies Inc. remains a buy, but valuation is demanding and upside is now more normalized, based on a fundamentally driven EV/EBITDA approach. PLTR's elite growth hinges on maintaining the Rule of 80, combined revenue growth and margins, supporting a base case price target of $183.84, 11% upside. Risks include premium valuation tied to AI optimism and potential international commercial growth headwinds due to geopolitical tensions and CEO's pro-US stance. PLTR's operational leverage, robust free cash flow, and unutilized $1 billion buyback program support long-term growth, but rapid stock appreciation is unlikely to repeat near-term. I am Dhiren Bekai. Using my aerospace engineering expertise, I provide a data-driven approach to investing ideas in the growing aerospace, defense, and airline industry. I run the investing group, the Aerospace Forum. Palantir Technologies Inc., PLTR, is a leading provider of artificial intelligence, and the stock price has gained over 100% over the past year. However, since my last report, the stock is down 10%. In this report, I discuss the company's risks and opportunities, expectations for Q4 2025 earnings on February 2nd, and update my price target with a deeper look on how to determine a reasonable premium for an elite growth name. The opportunities and risks for Palantir Technologies. Opportunities for Palantir Technologies are big, as AI can be leveraged throughout governments and commercial enterprises to optimize businesses. A major application opportunity is injection of AI into the analysis and decision layer of complex defense weapon systems. The Golden Dome project is one example of that. What we quite often see is that Palantir Technologies by some investors is considered a replacement to prime defense contractors such as Lockheed Martin, LMT, Northrop Grumman, NOC, Boeing, BA, RTX, and General Dynamics GD. That possibly is driven by CEO Alex Karp's style with a critical tone on the broader defense industrial establishment. However, despite that tone, Palantir Technologies is positioned somewhat differently than many would think. Rather than competing with prime defense contractors, Palantir Technologies partners with primes such as Boeing, Lockheed Martin, RTX, General Dynamics, and Northrop Grumman. Instead of competing, Palantir Technologies partners with the industry, and I believe those opportunities are driven by Karp's criticism on the industry. So the tone and criticism does not reflect strategic positioning. It is part of a strategy to drive a certain outcome. That outcome is partnering with the industry. Risks are also there. From investor point of view, the valuation is high and driven by optimism on AI. If that optimism deflates, for instance when the market goes in risk-on mode or growth evaporates, Palantir Technologies is among the extremely overpriced names. Furthermore, we note that the pro-US tone of the CEO may help the company with US government contracts, but with rising tension with other countries, it may limit market growth with international customers, as well as commercial customers. I believe that US government provides a stable growth engine. Commercial contracts do provide the high growth engine, but that is where we have to see that commercial, and within that commercial bucket, the international business remains robust in terms of growth, or whether tension is causing growth to deflate. What analysts are expecting for Palantir Technologies in Q4 2025. For the fourth quarter, analysts are expecting 62% growth in revenues to $1.34 billion, with a low estimate of $1.31 billion and a high estimate of $1.41 billion. Earnings per share is expected to be 23 cents, marking 64.1% growth, with estimates ranging from 21 cents to 27 cents. Palantir Technologies gives a clue on its valuation. The difficult part about Palantir Technologies is how such a high-growth company should be valued. Palantir Technologies actually gives the clue in a graph they present quarterly during the earnings presentation. As a rule of thumb, what can be applied is that the sum of the revenue growth and the operating margin assigns a reasonable EV/EBITDA. For Palantir Technologies, by Q3 2025, the sum was 114%, or an EV/EBITDA of 114 times could be justified. This linear relationship between growth and margins only holds for companies with elite growth. In my analysis following the Q3 results, the EV/EBITDA for Palantir Technologies was 292x. Technically, that means that over half of the valuation is hype. The rest is premium based on the high growth profile of Palantir Technologies. I mapped the multi-year expectations for Palantir Technologies for the years ahead, and by doing so, we see that reasonably, we can expect Palantir Technologies to remain above the Rule of 80 line in the years ahead. That is elite growth territory. The scalability of the business here is key, and I believe it could ultimately approach 68% in margins, requiring at least 12% growth in sales to remain above the Rule of 80 line. If Palantir's margins are weaker, or revenue growth weakens, the valuation does become margin-driven rather than velocity-driven. That is something to keep in mind. From that, we derive a 92.3x average EV/EBITDA, as we also transform the EBIT margins to EBITDA margins. Previously, I simply took the current EV/EBITDA and divided that by 2. With this new approach towards determining the EV/EBITDA, we get a lower EV/EBITDA, but one that is more fundamentally driven. New stock price for Palantir Technologies reflects better supported elite growth valuation. To determine multi-year price targets, the Aerospace Forum has developed a stock screener that uses a combination of analyst consensus on EBITDA, cash flows, and the most recent balance sheet data. Each quarter, we revisit those assumptions and update the stock price targets accordingly. In a separate blog, I have detailed our analysis methodology. I previously had a $229.51 price target for Palantir Technologies. As I now use a different EV/EBITDA multiple, which is better grounded in growth and margin realities, that target has come down to $183.84. That is the base case price target, and more optimistically, the price target would be $265.52. The base case price target suggests 11% upside, while the more optimistic target suggests 60% upside. So, Palantir is not cheap, not against the peer group, and also not against its more fundamentally supported elite growth EV/EBITDA. I do see a path for the company to head towards $500 per share in years from now, but all of that requires the company to remain above the Rule of 80 line. If that combination of margin and growth weakens substantially, the premium for Palantir Technologies cannot be justified. While growth prospects are definitely there, the current high valuation and associated risk to the applied multiple make this an expensive buy rather than a typical buy or a strong buy. In terms of the operational metrics, I expect revenues to grow substantially combined with EBITDA growth. With little capital intensity, free cash flow generation will be substantial and ultimately boost the company to a $36.7 billion cash position. I am not assuming that the company will be in a rush to buy back anytime soon. The company has a share repurchase program in the amount of $1 billion, which remains unutilized. Company filing. In August 2023, the company's board of directors authorized a stock repurchase program of up to $1.0 billion of the company's outstanding shares of Class A common stock, the share repurchase program. The company may repurchase shares of its Class A common stock from time to time through open market purchases, in privately negotiated transactions, or by other means, including through the use of trading plans intended to qualify under Rule 10b-51 under the Exchange Act in accordance with applicable securities laws and other restrictions. The timing and the amount of stock repurchases under the share repurchase program have been, and in the future will be, determined by the company's management, based on its evaluation of factors including business and market conditions, corporate and regulatory requirements, and other considerations. The share repurchase program does not obligate the company to repurchase any specific number of shares and may be discontinued at any time. As long as Palantir Technologies remains above the Rule of 80 line and valuation remains that of an elite growth name, I also do not believe they will be in a rush to repurchase shares. Conclusion: reasonable valuation shows Palantir is not cheap. The difficult part about Palantir Technologies and its valuation is simply how to value elite growth names such as Palantir. I previously took the current EV/EBITDA and divided that by 2. However, there is no fundamental basis for that. It is an arbitrary way to value the company. The new valuation standard I use is more fundamentally driven and values the company like an elite growth against a relatively reasonable price. That also shows that upside for 2027, valuing the stock 1 year ahead, is more normalized, but with substantial growth in the years ahead. The main risk from valuation point of view is that the company needs to continue growing at margins that keep the company above the Rule of 80 principle. Below that combination of growth and margin, the margins become predominant in the valuation multiple, and downside increases. For now, I am maintaining my buy rating. However, I note that we shouldn't expect another year of greater than 100% growth in the stock price, at least not when you want growth at a reasonable price. This article was written by Dhiren Bechai. Micron.
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.